Hello there, everybody. It's time to get started, and thank you for taking time out of your weekend to be here. Very nice to see you in our room today, members and guests as well. This is Craig at Max Trading, along with Chris and Eusebio, and all of us are very excited about today's webinar. This really is a great time to learn about the upgraded edition of Max Training courses, and there will never be a better time to add Max methods to your charts, giving your trading results the opportunity for a really big boost. You know, 2018, as of today, is 50% gone. So if you plan to accomplish something more as a trader during 2018, this is the time to get started. It actually was more than 4 years ago that Eusebio noticed the need for a reliable indicator to help us deal with the changing fluctuations and characteristics of the markets. And so he began to develop and test what we now call the Max Enhanced Trade Format Indicator, or the Max ETF. This has been available to upper level members of the Max community for just a very short number of years, and now we have added it to all levels of Max training so that everyone has an opportunity to add it to their charts. This means that you can select any level of Max training course, and you will also get the ETF indicator and training and how to use it. And for you, this is a big deal. This can make a huge difference in your trading, and it will give you a real shot at becoming the kind of trader that you want to be. So all in all, it really is an exciting time to get in on Max trading and take that crucial step into productive and successful trading. It may be that you just need an extra source of cash every week for yourself and your family, or maybe you're wanting to help a friend or a relative, or there might be some worthy cause that has gotten your attention, and you can sort of see yourself, imagine yourself being in a position to really make a difference. Max is a great place to begin turning those things into reality. And so I believe you'll be very glad that you attended today. And by the way, we do believe that it is equally important that you see our trading methods on real-time charts, that you watch the price action and the trade management as it unfolds on the live charts. So if you don't already have it, I'll be sending you another invitation to attend a real-time trading session coming up this next Friday so that you can see it for yourself, the effectiveness of the Max trading system and the ETF indicator. As the developer of ETF, there is no better choice than Eusebio to take us into the world of Max trading. He is a phenomenal trader, as you will discover, and also a very skilled teacher. He will be our instructor for all sessions of the ETF Standard course as well as the ETF Primer course, and I think you will appreciate his passion for trading and his interest in helping traders become successful. So Eusebio, we thank you for all that you do, and I'll pass the microphone along to you.
Thank you, Craig. Hello, everyone. Welcome to this Max ETF trading system presentation. So before starting, let's make a usual quick audio and video check. Do you see my screen and do you hear me well? If you'd like to type a yes or a Y in the question area. Oh, fast answer. Thank you very much. That's really nice. Interactivity is always interesting because it helps to learn faster and deeper. So before explaining what the Max is, let me give you just a very short background of who I am. You have perhaps guessed through my accent that I'm not speaking English as my mother tongue, but I am in fact a Belgian trader living in France. for many years now, sometime in Belgium too. And I am a full-time trader since 2008, but I have that passion of trading and investing for around 30 years, now more than 30 years, 34 years exactly. But this was not my profession, my profession until 2008. Before that, and during 27, 28 years, I was software engineer, and I have worked as a service manager in an IT company, and fortunately during the 15 last years of my career in that field, I have been in contact with many banks here in Europe, and this has given me the opportunity to be in contact with several traders in the bank and to see how they trade, especially the Forex market, but also the stock market. And so this is for my background. So what I'm going to explain now is some concept of the MAX, and I will mainly illustrate them through some examples, and then I will mention some results, some objective you can achieve with the MAX and through our money management approach. I would like first of all to apologize because you can hear that I have a small problem with my throat. Indeed, almost 2 months ago I have had a surgery, and this is a small consequence of that surgery. So, so in fact the MAX has been created many years ago by late Dr. Jim Pruitt, known as Tiger, because he had a very strong temperament. And his aim was to give the traders, his students, in fact, a powerful but also reliable and flexible trading method. And if the MAX is a trading system which is based on a few concepts and many rules, however, it requires two essential keys to be successful. So work and commitment. Indeed, work, because it takes time to understand all these concepts and all these rules, and how to understand the context under which these rules apply and how they apply. And because it requires a lot of work, there is another key which is important: commitment. You need to have a strong commitment, a strong motivation to sustain the efforts which are necessary to become successful with the MAX. But there are also other keys to develop: discipline, patience, persistence, concentration, confidence. Discipline and patience seems obvious, indeed, because I have said that the MAX is based on concept and rules. We have to apply these rules in a strict way with discipline and patience. A rule is in fact a set of conditions we want to see fulfilled before taking one decision: to buy or to sell, to open a trade, to close a trade partially or totally. And so we need to wait with patience that all the conditions are fulfilled, and this takes discipline. And when it is time to act, we have to act. Persistence also. Persistence means that even during a more challenging period, when we are facing more losing trade than usual, than the average number of losing trades, it is important to continue to trade, because in fact many traders ignore that losing streaks exist and they are longer than what we can imagine. For example, let's take a trading system having an 80% winning rate. 80% is an important winning rate. But even with such a winning rate, we can still face losing streaks made of 5, 6, 7, up to 10 losing trades in a row. This is not uncommon. But many traders usually will think the trading system they are using is not very good after 3 or 4 losing trades in a row. And so doing that means that they are not in the statistics of the losing system, of the trading system, sorry. Then concentration, because we have to pay attention, to apply a lot of rules and to apply them in relationship with the context. this requires a lot of concentration when we trade, and especially when we trade small time frame like the 5-minute time frame, the 15-minute time frame, and sometimes even the 1-minute time frame. We have some max traders trading the 1-minute time frame. And confidence, of course, we need to develop confidence in the market itself, understanding and observing that the market provides us with many opportunities day after day after day, but with the max and in ourselves, in our ability to apply the rules correctly. When we talked about a trading method, what do we mean with a trading method? It is important to define what a trading method is or is made of. First of all, it seems to be obvious that we have to define the kind of movements we want to trade. Usually we call these movements within the max as trends, but we have to define what a trend is. We have to define when or how trends may start. And the conditions defining the beginning of a trend or a continuation of the trend later, we will call that a setup. We have to define also when the setup is valid, because not all the setup will be tradable. We will have 3 types of conditions before deciding to trade a setup. We will have technical conditions, we will have risk conditions, and we will have global context conditions. As I have said previously, we apply the rules of the max under the global context and depending on the global context. We have to define then how to handle the trade during the movement is unfolding in order to progressively reduce the risk we have on the trade, possibly to cancel the risk, in which case we are in a risk-free situation, and then how we can optimize the profit from that trade, from that movement we are trading. And then we have, of course, to define when a trend will exhaust. We can never say in advance when the trend will reverse, when the trend will end, but at least we can say when the trend is exhausting, even if the trend resumes later, which will give another opportunity to open another additional trade. And so this is what we do with the max. And in fact, the max is an acronym which stands for 3 important concepts. The M stands for momentum. We want indeed to take a trade only when there is enough but not too much momentum and enough but not too much volatility. Then the A stands for acceleration. During the trade, and as long as the trend will allow us to do that, we will add to the trade in order to progressively increase the position size, in order to increase the profit we will make from the trade. Doing that, we will have to control the risk on that new and increasing position, of course, in order to control the potential loss we can still have under some predefined limits. And the X stands for exit. At some points along the trade, I will show in a moment with some examples, we will have to decide to exit partially and finally totally from the trade. And so the max is, in that case, essentially a trend following method. There are also possibilities to trade counter-trend movement and consolidation area under some specific circumstances, but essentially a trend following method, depending on how we define a trend. And so we apply also a very strict trade risk management and a very strict money management in order to control not only the trade risk but also the financial risk when we are in a trade, and how to increase, how to grow the trading account, and how to control the possible drawdown we are facing when we are facing losing streaks. And so under these concept, the max is in fact applicable to all time frames and to all tradable market, the stock market, the forex market, the commodities market, and so on and so on. It is also important to understand what the MAX is not. The MAX is not a scalping trading system. We are not interested to chase a few pips in the shortest possible period. We consider that scalping a market is the most difficult approach of the market. As retail traders, especially in the Forex, we are not well armed to scalp the market. Of course, it is always possible to scalp the market with a higher time frame, of course. The MAX is not a news trading method. We don't try to catch these nice spikes the price regularly exhibits when we have an important news release with a surprise. Because during that spike, in fact, the volatility is so high, the liquidity may be very low or lower, or there may be a competition for liquidities. And so we see usually the price not only moving fast, but also the spread widening in an amazing way. And sometimes they are widening so much that even if you succeed to open and close a trade during these spikes, you still may have a losing trade, despite the fact that you can believe you have a winning trade because of these large spread. And so the MAX is not an elementary buy and sell system using simple, elementary, rigid rules. We have flexible rules which must be adapted depending on the market conditions. And so to do that, of course, we use, with the MAX, we use indicators, we use price action, and using these tools or these information, the price action is an information we have in real time. We will define our entry setup as possible opportunities. And as I have said, possibility to open a trade, and as I have said, based on 3 types of conditions. So I will quickly repeat them: technical conditions, risk conditions, and global conditions, global context conditions. And our exit setups will be defined not as a prediction that the price will reverse. We never try to predict what the market will do, but we'll define an exit setup as a situation in the price movement when we are facing a risk too much important. And in order to quantify the risk we have when the price is going against the trade, we will use a set of tools, and tools of different categories, like technical indicators, like price action behaviors, a combination of price action and indicators, but also timing aspect, and then what I call a movement invalidation concept. And of course, but this is implicit in a trend following system when we have a trend exhaustion or a possible trend reversal. So these are the different types of exit conditions we have, and I repeat, they are defined simply as risk situations when we have to take a decision to limit the risk we are now seeing appearing in our trade. After 2008, you remember 2008 has been a tremendous year, especially the end of the year with the subprime crisis. And we have seen at that moment a tremendous momentum and volatility, extreme momentum and volatility. And several years later, we have seen these momentum and volatility decreasing. Nowadays, we are in a time period for several years now with a low momentum and still some volatility. And this creates some challenges when we use a trend following system. These challenges, or some example of challenges are the following. We may have poor price action. This means that we may have small price movement, and this will happen very frequently when the market is very quiet. The amplitude of the movement during the day are small, 20, 30, 40 pips. We may sometimes miss an ample movement because the price can reverse very quickly. And because of that type of behavior, we will have a lag, and so a lack of reactivity in some of the indicators we are using, or we were using before we introduced the ETF concept into the MAX. And in the classical MAX, before we introduced the ETF concept, we were defining a trend concept and a counter-trend concept. I will explain in a moment based on a chart. And with the MAX ETF, we have been able to combine as a same trend, a counter-trend and a trend movement. And another challenge we have is when we use time bar chart, whatever the time frame, 5 minutes, 15 minutes, daily time frames, we have always a loss in the details in the price movements itself. And so a second improvement we call the sum consists in using other types of charts, and in fact we can use, for example, Renko bar chart, but we use a constant range bar chart. And so with the ETF and the sum, we have been able to solve many of these challenges we have when we have more difficult days in terms of trend following system. Just to illustrate the drop in the volatility and the momentum these last year, I have taken just a few examples, a few pairs here. I'm showing the Euro US dollar and the pound US dollar, and we can see that from 2010 up to now, how the momentum and volatility is by nature cyclical, and we have regularly drops in these momentum and volatility, and of course when the cycle reverses, we have an increase in the momentum. But the problem comes when we have a drop in the momentum and volatility when we trade with a trend following system. This is the case for the main pair, the major pair, but also for the crosses, like for example the Euro Kiwi or the Pound Yen, for example. You can take any pair you want, you will observe that drop of the momentum since several months now and even several years. And so in order to overcome these challenges I have just explained and to better adapt to the market evolution, so we have developed and introduced the ETF concept, which is, as Craig has mentioned a few moments ago, available in all the level of the MAX courses. We have in particular 5 levels of the MAX I will explain in a moment. What I'm going to present today is the MAX Primer level and the MAX Standard level. And the ETF concept, or its introduction, is the MAX has the aim to be able to trade many more movement, but also larger movement if we are able to combine a counter trend movement with a trend movement, and so into a unique directional momentum movement. And so just to illustrate this concept with some example, I'm going to take a very recent movement here. It was this week, I think it was Wednesday, Wednesday, on the Euro US dollar. If you look at our web page, Max Trading System, the news watch list, you will see somewhere in the page that every weekend we propose a limited number of pairs to follow every day of the week. And Wednesday, the pair we were suggesting to trade were the pound Aussie or the pound Kiwi, the Euro Yen and the Euro US dollar. And so I have taken the example of the Euro US dollar here. The context was to short the Euro or going long with the US dollar. This was the global context. And at some point we have had, indeed, just after this news release, which was a news release related to the Euro, it was in fact the M3 money supply, we have seen the price moving in a downtrend. And what we call the ETF is these two lines in orange and yellow. I'm going to take my red spot to better show on the chart what I mean. So that line, which is a combination of a yellow and orange line, is what we call our ETF lines. It is a sophisticated kind of moving average. And it is faster than any of the exponential moving average we were using in the MAX, like our momentum line, which is the yellow line here, the blue and the red balance line, and our home base. In the classic MAX, what we call a trend is a movement on one side of the home base. When the price is moving below the home base, we were looking for short trade. And when the price was moving above the home base, we were looking for long trade. But now with the ETF, we are able to trade also the counter trend movement when the price, for example, is going upward but toward the home base. This is a counter trend movement, and if the price continues to go upward, we will have then one unique movement made of a counter trend and a trend. But here we have what we call an ETF trend. The ETF trend so is illustrated with that ETF line plus its companion indicator, which is a directional indicator, which is the indicator here at the bottom of the chart. It is made of two lines, one in green and red, and one in blue and brown color. The blue and brown color line represent a short-term bias, and the red and green line represent a long-term bias. And this long-term bias gives us the direction to trade. And here the direction was to go short. Of course, you can see that during that time period when the long-term bias was essentially red, we have had 3 periods when it has turned to green. But during these 3 times period in the chart, we had no setup to go long. And so if we were engaged in a short trade at that moment when we have seen an attempt for the trend to reverse, because we were not seeing a setup to go in the opposite direction, so to go long, we had simply to stay in the trade. And we have been able to stay in the trade until almost the end of the day, which is indicated by this red line, because at that red line, which goes on to midnight on the platform, we had another important news release, which was the official bank rate on the New Zealand dollar. And so you can see already that we don't try to trade these news releases. We wait until the news release. We trade after the news release. An important rule we have is if we are engaged in a trade, we will close the trade half an hour before the news. If we are not in a trade and we are seeing a setup appearing, we will consider to trade that setup if there is time enough before the news release, minimum 1 hour. And so here, so after the news on the euro, the M3 money supply, we have had, in fact, a trend reversal from an up movement to a down movement. The long-term bias has turned from green to red, and exactly at that point we had our entry setup. Now you can see 2 sets of notations, one in yellow, one in white. The white color represents the decision during that movement with the classic max, and in yellow with the ETF primer, max ETF primer, just to give the comparison between the 2 approaches. It happens in this case that the movement we were trading here corresponds to a classic trade, but there are still differences between the 2 approaches. And so now let me explain some details. So here we have a condition which technically is called a breakout REMO, an ETF breakout REMO, telling us that technically we have a good opportunity to open a short trade. The context was favorable and the risk was favorable too, because the stop loss was only 16 pips. We have constraints on the stop loss we have to apply. Whenever we open a trade, we consider the trade is made of 2 units. The size of these 2 units, and so the size of the trade is calculated with the position sizing concept. We defined that during the course, but we consider the trade is made of 2 units because later, at some point along the trade, we will have to close half of the trade, so 1 unit. And we will call such a close, which happened here, we call that an MX. So here we have an MX number 1, it is the first MX. We close 1 unit of the open trade. And we have some result. It may be a positive result, it may be break-even, it may be a negative result. In this case, plus 8 pips. And then we had to stay in the short trade because we have had at no moment set up to go long, so we have stayed in the trade. And at this point here, another exit condition has appeared, Because we were left with one open unit, we have closed that unit. And a final close is called an XXX. And this second unit has been closed with a profit of 24 pips. This means that the trade has made a profit of 32 pips, and because the stop loss was 16 pips, the realized reward to risk ratio is 1R. Indeed, we have to divide the 32 pips by 2 to have the average result of the trade. We have 2 units per trade, so 16 pips divided by 16, which is the size of the stop loss, and so this gives a +1 reward to risk ratio. 1 reward to risk ratio, 1R, mean that R represents the risk, the financial risk. If your risk is 2% of your trading account, 2%, this means that that trade has produced a profit of 2%. Later on, at this point, we had another entry setup to go short. And similarly, we have closed one unit here and the second unit here. The stop loss was here. It was larger, 26 pips, with a result of 0.48 R. And then a third trade here. It was what we call an ETF REMO. Each of our setups has a specific name to help us remembering the conditions. Immediately after the price went against the trend, we have been forced to close one unit here, and then our final close here. And this third trade was a losing trade. The loss on that third trade was 13 pips. The stop loss was 19 pips, and so the realized reward to risk ratio was minus 0.34 R, so 1/3 of R. And then a last trade with the same behavior, the same approach, for a final result of plus 1.6 R. You can see that 4 trades has produced a total of 2.19 R. This is the ETF primer. During the same movement with the classical max primer, we would have had, but this is a coincidence, the same decisions here, except for 2 details. First of all, with the classic max, we have usually larger stop losses. In this case, the stop loss was 25 pips for the first trade. It was 25 pips for the last trade, and we have had only 3 trades. The third trade of the Max ETF primer was not available, in fact, with the classical max trade. And so you can see the result here. And despite the fact that with the Max ETF primer we have had a losing trade, the total result was larger than the result obtained with the classic max primer. So this shows an improvement in the result by approximately 10% of the result of the trades. Now the same movement, when we use the max standard, classical or ETF, gives something different. And I need to come back to my normal cursor to change the page. In the classic max standard or the max ETF course, we use a concept of scaling in. We progressively add to the trade in order to increase the position size, and so the trade was made with just one trade, an entry here and a final exit here, and all the in-between steps were MX, so we were closing one unit, or what we call scale-in, or SC in abbreviation, we were adding 2 units on the position. So we have here an entry, an MX, we close 1 unit, we have a scale-in, we add 2 units of the same size, we have another MX here, we have another MX here, we have a scale-in, an MX, a scale-in, an MX, and so on until the end of the trade here. Note that the final close was made approximately 1 hour before the next news release and before the end of the day. And so 6 scale-ins along the trade, but also scale out along the trade. We have had 9 scale out. And so the total result of that trade with the scaling technique and the max ETF standard has produced a nice 261 pips, representing with a stop loss of 16 pips. It was the same stop loss as the primer, so a nice 8.16 R as the reward to risk ratio. The same trade with the max the classical max, so without the ETF, we had exactly the same trade except as previously a larger initial stop loss, and the scale-in number 4 here was not available. So we had one scale-in, instead of having 6 scale-in, we had only 5 scale-in, and you can see the difference in the result. Just one scale-in has been able to almost double the result. Not only one additional scale, but also a smaller stop loss. Of course, the two contributes to a larger result. So this was a movement this week on the euro-US dollar. But we have also other examples. For example, this was a past example, a past trade in March, the 27th of March on the pound kiwi. This is a cross with a large spread usually. And here we can see the typical similar trade with the max ETF primer or the max classical primer. Just focus on the result. We can see a difference in the number of trade, but we can see a big difference here in the result. On this chart we have something else. We have that white line, which is what we call a max price level. We provide max price levels every week. They are calculated during the weekend, and so that they are available for the entire following week. And we may have several lines on a chart. I define them based on several time frames, and they represent possible supply and demand level. And you can observe here that it was a short trade, having started before the price was below the home base and on the right side of the max price level. If you compare these results with the same movement traded with the max standard or ETF standard, you can see a very important increase in the result. These two examples were in the 5-minute time frame, but we can, of course, this is another example. We'll not go into the detail of these. You can see sometimes we may have a very large reward to risk ratio, but we can use also the max, of course, in higher time frames. This is an example of a daily time frame. At that moment, the companion indicator was not in 2 colors, so we had only 1 color here. This is an example of a long trade. With the max primer or the max standard, the classical, we would have been able to exploit only this small movement. This is a nice example when we may have the combination of a counter trend movement and a trend movement. And so with the classic max, we are able to exploit only the trend portion of the movement, and you see the result. And with the ETF, we are able to exploit also the counter trend movement inside the same directional momentum movement. And so we take, first of all, larger movement, and we are able to increase, importantly, the result we are able to extract from that movement. Here, especially, we were able to make a 7R profit from that movement. So this was an example in the daily time frame, but I can show you also many examples in all the other time frames. Of course, the example I have shown are winning trades, but we don't have only winning trades, we have also losing trades, of course. With the max ETF, we have approximately between 60 and 70% winning trades, and the rest, 30 to 40%, are break-even trade or losing trade. We have approximately 20% losing trades. But the main feature, and this is the advantage of the max, is whenever we have a losing trade, if the rules are applied correctly, the loss is always a small loss. This is an example of a typical losing trade. We had here a setup, exactly here, a setup to go short. And immediately after, this is something we have all experienced, and we continue to experience, of course. Immediately after the trade has been opened, the price goes against the trade, and at this point, we had the conditions to close 1 unit. We had an exit setup to close 1 unit, and then later, a second exit setup to close a second unit. And so the loss was a loss, if we add the loss of the 2 units, a loss of 22 pips. And because the stop loss was 24 pips, the reward to risk ratio, which was of course negative, was minus, not 46R, because this is insane, but it was in fact minus 0.46R, so a little less than minus half R. This means that with a risk of 2%, for example, you would have lost only 1% with this losing trade. And so this is the feature of a losing trade with the max. A loss is always a small loss with the max, because of the way we consider the trade risk. And we never try to guess what the price could do or should do or would do. No, as soon as we see a risk in the trade, and if the risk becomes important enough, we take the decision to limit that risk. Of course, I have said that the rules apply depending on the market conditions. We have several types of market conditions. In fact, we call them price modes. And when the price is moving with enough momentum and enough volatility, we will call that type of price movement as a trend mode. And when the price makes a pullback, we will call that a counter-trend mode. But we may have also a consolidation zone mode when the price is ranging. It may be a small range, in which case we will call that a squeeze, or it may be a large range, in which case we can still trade inside these large ranges. But we may have also a choppy market. We have the choppy mode when the price behaves in a very complete erratic way. For each of these price modes, we have a set of definitions to help us recognize these price modes. And fortunately, when we recognize a choppy market, which is the most difficult price mode to recognize, but fortunately, when we have a choppy market, a choppy mode, we have extremely few entry setups. We can so decide either to not trade a setup when we are in a choppy mode, or we can decide to trade the price, the movement in a choppy mode, but we will then apply specific rules to handle such kind of trade. But fortunately, they are not so frequent. So this is what the max is. So the max recognizes the conditions under which the price is moving inside a potential trend. We define what a trend is, and we define how to exploit a trend, or how to exploit a trade depending on the price mode the price is moving with. Okay? And so when we have that, so because we have a high winning rate, a small losing rate, a profit, an average profit which is way larger than the average loss, the loss is always a small one with the max, we can have an idea of what such a feature of the max can provide in terms of result on the long term when we compound our result with our money management. And this is just a small example of what can be achievable. Let's suppose that we start with a $10,000 account. And let's suppose we take a risk of 2% per trade. I'm going to take the red spot in order to better illustrate what I mean. Let's suppose we take a risk of 2%. Personally, I consider that 2% should be a maximum. Personally, I use a smaller risk per trade, which will be between 0.5% and 1% depending on the market conditions. So, but let's suppose a 2% risk, and because when we define objectives to be achieved, we have to make some assumptions. And so let's suppose we have a very conservative average stop loss of 30 pips. With the max ETF, usually we will have, at least in the 5 or 15 minute time frame, a smaller stop loss around 20 pips. But let's take a very conservative size of 30 pips. And we use 2 units per trade. And so let's suppose that we are able to catch with one trade or with several trades a total result of 60 pips. So we have a reward to risk ratio of 1R. 1R, remember, the 60 pips here is the result of the 2 units. And so we need to divide that result by 2 in order to have the average result of the trade, so 30. And when we divide 30 by the stop loss size, we get the realized reward to risk ratio, so 1. And I will suppose that we make never a withdrawal from the account. Now, don't get me wrong. These conditions are strong. I don't say it's easy. Sometimes, someday you will make a better result. Some days you will make a smaller result. Some days you will have a loss. This will happen. I never consider as important the result of one unique trade. I'm interested of the result at the end of the day. Okay, you may have, for example, 10 trades in the day, only 3 winning trades, let's say 6 or 5 losing trades, and 2 break-even trades. At the end of the day, you may still be profitable, and this is what is important to consider. And so some days you will have a better result, a smaller result, a loss, and it is not obvious that you will be able to trade every day. But let's make these assumptions. And so if you are able to achieve that result every day, so we can see that after 1 month here, the account will have grown by around 50%, which is important. 50% is important. And the account will have doubled. If this is our objective, to double the account will be doubled in 36 days or 2 months. You can see here after 36 days, we have an account having grown to 20,000. Now, this is just to give an idea, a raw idea of what can be achieved. Of course, usually it will require more days because you will not trade every day. You will not get the same result every day. So usually you will have more days to double your account, but sometimes it will take less time to double your account. It depends how you will develop your skill to apply the max. And so if you achieve consistency in applying the max, and I say consistency not in the result but in the way you apply the rules in a strict way, you will get this kind of result with your account. I will not go to the second page. This is another example of what you can achieve after 1 year, for example. And so the max is organized in 5 levels. The max ETF primer course, which is a very simple version of the max, which is a first way to consider what the max is, to help you estimate if the max is a good trading system and if your teachers are good teachers, in fact. Then we have the max ETF Lite course. The Lite is a more elaborated version of the primer course, but with more entry setup, with more exit conditions. And we go a little more deeper into the news release. And then we have our flagship course, which is the Max ETF standard course, which contains all the concepts of the max with the scaling technique, the scale out technique, an elaborated trade risk management and money management. And so it is a complete course, in fact. And the primer and the standard course are the course we propose to you today. Then we have an advanced course. In the advanced course, we approach subjects like how can we define situations when some discretionary decisions are possible, and how we must handle these kind of situations. How can we compare different markets in terms of intermarket correlations, how we can deeper profit from the news release. There are a lot of things we can exploit from the news in terms of how we have to adjust our trading style. And we focus also on the concept of currency strengths when we analyze which currencies are strong, which currencies are weak, and how we can exploit in trade these strong and weak currencies in order to exploit the movement in a better way and to pinpoint, in fact, big movers in the market. And this is especially the case when we have an important surprise in a news release. And then, but these advanced concepts are not necessary to the traders. If they limit to the max standard, that's well enough. If they want to go one step further, to improve their result, they can consider to take the Max Advanced course. And then we have the Max ETF SAM, which is our uppest level of the course, which is accessible if you have taken the standard course. And the ETF SAM course is the version of the Max Standard when we go deeper into the details in the price movements and how we can adjust also our chart consequently. There are some simplification we can consider when we use constant range bar chart instead of time bar chart. And so, to complete my presentation here and to give the mic back to Craig or Chris, I would like to conclude here with the fact that with the Max we have a strong trading methodology. I don't say system but methodology, because we have to analyze what is happening in the market, but also outside the market, to recognize where the opportunities are, which are based on sound concepts. And during the course we explain why these concepts work in relationship with what the big boys are doing, because it is well known that it's only the big boys who move the market significantly. And during the course we attach a lot of importance to the fact that, of course, we use indicators, technical indicators, but we do not trade the indicators. We always trade only the price action. The indicators are simply tools to help us pinpoint faster where the opportunities may be, potential opportunities may be, and where potential risk may appear. But then the price action tells us how we must take and implement our decisions. And then the trading approach is completed with a very solid trade risk management and money management approach. For example, in the Max Advanced course, I have not mentioned it previously, I describe a way to completely master the drawdown if we are facing many losing streaks. We can predefine a maximum drawdown, for example, let's say maximum 20%, and if you apply the procedure I describe, you will be guaranteed to never exceed that maximum drawdown. And then this means that the priority we have, the very first priority we have when we are in a trade, is always to follow, to monitor the risk on the trade. The trade risk management is always the first priority of a Max trader, never the result of the trade. And so for that, we try to develop personal confidence with our students through several types of activities, the coaching or mentorship approach, the homework, we assign homework, Chris will mention a little more about that, the practice also, and follow-up activities like the workshops we have, like the forum we have, the discussion in the forums, and the scrolling parties we have every Saturday on essentially the Max Primer level, but around in 25%, 30% of the case on the Max Standard, and in 25% of the case about the Max SAM. And so this helps me to complete my presentation. If you have questions, feel free to put them in the question area. We will make our best, but I see that Craig and Chris have already answered many of them, but we will still have a few minutes later to answer additional questions you may have. And now I give the mic, if he is present, to Chris. Chris?
Hi everybody, my name's Chris. I'm based in New Zealand and I'm a partner with Eusebio and Craig in this Max trading system. This is our 59th set of courses. We've been running for a little bit over 10 years now. Jim Pruitt, the original developer of the Max, started things off in 2007 when he made his first course, and since then we've trained over 2,000 people. So just to give you some idea on what we're like, there's been some questions in there about being able to double your account within 36 days. This is presuming that you're a good trader and that the conditions are good. As Eusebio was saying, lately the conditions have been, the ranges have been quite tight, so it's more difficult than it was back in 2008 to make huge profits. Nevertheless, just recently well, sorry, during the Brexit point, when the markets were jumping up and down a lot, and you have to be in to win kind of thing, you have to watch the charts. One person was able to increase his account by 60% one day by trading a very, very small amount of it, something like 1/3% or 1/2%. So huge gains can be made out of very large movements, but you have to be ready and watching the markets. Yeah, okay, enough of that. Next slide, please, Eusebio. Thank you. Okay, I'm here to tell you the pricing and when the courses are on. But before that, but first, we have some steak knives for you. The thing that makes the Max, excuse me, I think it makes a difference with the Max from other training courses is that we assign you homework. We have a really good system. There's a lot of detail in it. It's very precise, but we want to make sure that you know how to use it. And generally, most people, when they're handed out a PDF or a video, will watch and think they can then go off and start trading it. There are a lot of nuances with these things, and by doing the homework, we can verify that you've understood what's happened correctly. You'll be able to sit down and mark out your chart. It's all it is just chart marking, no essays. And you send them in to us, and we go over them pretty much bar by bar to see if you've understood the concepts. And if you haven't, then we'll explain what's going on and point out where you can get better. And I know when I mark the homework, if somebody's not doing things very well, then I'll assign them extra homework to do to make sure that it actually gets embedded in their heads. Sometimes people mark the charts 1 or 2 bars too late and do that consistently, and once or twice is okay, but if they're doing it consistently, we need to knock that out of them before they actually sit down with their cold hard cash and start trying to make money, because even 1 bar or 1/2 a bar too late will lose your profit or some of your actual capital. We don't want that to happen. The other thing that the homework does is it embeds it in your head. It crystallizes the training. So as I said, rather than just reading a PDF, you actually get your hands dirty and you get to see what happens on the charts. It's still not exactly the same as real live trading, but it puts you in a much better position than just having read a few words on a page and then trying to use our system. Next page, please, Eusebio. You'll be able to see everybody else's homework as well. Most people only care about their own homework, so don't worry if you send yours in, because everybody else will be too worried about theirs. Here's an example of what the homework looks like. On the left-hand side, I had to figure that one out, is an example of a chart with an entry setup. It's called a breakout Remo. We'll teach you all the jargons. It shows you where the stop loss is. We'll show you all of that. And there's the entry there. And on the right-hand side is a completely different answer to it, but it's how the homework is replied to. So the entry is perfect. It's not exactly, second entry is not correct. It's not there on the chart, but it gives you an idea on how much detail goes into the replies. It probably takes just as long to, or does for me, to answer the charts, to grade the charts, as it does for you to actually build the charts in the first place. We want to make absolutely sure that you understand this before you get into trading your money. The trading is difficult. It is hard, especially these days with such small movements. And if you don't know what you're doing, where to get in, and even more importantly, I think, where to get out, then it's going to take a long time before you become proficient with this. So next chart, please, Eusebio. So we really, really hammer on about the homework. And every course that we run has homework. So here's an example of what the courses are that we actually run. The first two, ETF Primer and ETF Standard, are just the ones that we're offering today, as Eusebio was saying. The standard one is our flagship. This is the one with all the bells and whistles. This is the one that will give you all the scale-ins. So to give you an idea on the differences, the primer is a subset of standard. You don't have to do the primer, you can go straight to standard. If you want to just test us out for a couple of weeks and then do standard, you're most welcome, but you'll be even further down the track, several months down before you get to do the standard. So if you're really keen on getting into trading and want to learn everything, then the standard is the way to go. So the primer is 2 weeks, the standard is 7 weeks. The primer is harder because it's only 2 weeks long. I know it sounds strange. We don't teach as much, but you're kind of left on your own a lot more. With the standard course, you get a lot more coaching. So you get something like 6 or 7 different homeworks, and some of them are more difficult than the primer to do. But you will be constantly sending in charts to show your entries and different examples of exits. And because of all this repetition, you'll be in a much better position than the primer people, who will only have a couple of formal shots to send in their charts. You can still send in charts afterwards, but not many people do. But with the standard, you're kind of pushed along a lot more to make, and we get to see over time that you're actually remembering things and being able to make the charts and set up this, recognize setups for entries and exits correctly. So with the entries, primer has a couple of entries. Sorry, we've got kind of 2 courses running in parallel here. We've got 6 entries on the primer, and on the standard we have something like over 7 different entries. With the primer, we introduced, as Eusebio was saying, the ETF, mainly because the ranges have become so small, and Eusebio had developed the ETF to capture movements in a trend mode as well as their counter trend movements. And because the prices are in such ranging modes, then our standard entries were taking too long to fire off. You could have set for a week with primer and maybe only got 1 or 2 entries out of a pair. With ETF, you can get multiple entries most times, most days on most pairs. So you get a lot more action these days. The number of exits with the primer are only 4 with the primer, but we have over 20 different exits on the standard. And while that sounds like a lot, it's needed in order to be able to protect your profit and capture as much profit as possible. The profit acceleration, or the ability to scale in, is only available, like I said, on the standard. And this is the one that really makes the money. That's how we can say you can make up to 30 to over 300% on a trade when it's moving, because you're able to keep increasing the amount of money that you're able to put into it from when you start. So if you compare the two, like a standard trend entry and let's do this. If you compare a regular trend trading method, they might make X amount out of it. But then if you use the standard scaling methods on top of it, you'll turn out another 30% to 300% or more money from it. It just depends on the actual movement itself and how long it runs for. But these are not pie in the sky numbers. Thanks. So I've already said these courses are really precise and detailed. What we generally do is we show you how to find the setup, and then the execution is most times on the next bar within half a pip to 4 pips. It depends on how much the market is moving and what time you get in, but it has that precision. So we find the setup when the bar closes and the next bar opens, then we push the go button. Similarly for exits, within about 1 to 4 pips we'll be executing an exit. We use a MetaTrader platform to train with. This is pretty much throughout the world. we ask you to use one that's the same one for all the courses. We don't recommend any brokers because they generally all get caught with their fingers in their till. But we use one broker so that everybody has exactly the same feeds and the same charts. Even using different servers with the same broker can result in a different chart pattern, which is kind of interesting, but so that everybody's on the same page and you can look at your charts and other people's homeworks and the instructors' charts, then we use the same platform. We provide all the indicators and the templates for you, and also little instruction videos on how to set the things up. So if you've not used MetaTrader before, don't worry about it. It's pretty simple. You just copy and paste the indicators to the indicator folder and the template to the template folder. Then you go to the chart and you load the template and all the indicators will be in place. So no setup, and then you start working. We don't want you working on the platform too much. Well, it takes a little bit to learn it, but it's not a biggie. It's not the best platform, but it's good enough. And a lot of us still trade with it, and we also have, once you finish the course, indicators for other platforms like NinjaTrader, MultiCharts, TradeStation. I think that's about it. Others are getting, and if you want it for other platforms, we're quite happy to give you the source code. We provide all the materials. So once you've done the session, you'll get the video within about 24 hours, and the instructor will provide all the PDF, the notes, the templates and the indicators, like I said. You also get a transcript of the chat that's going on. So if you have any questions about anything at all, you just ask us. Oh, okay, Eusebio, thank you. So Eusebio's brought up our web page. So there's a list of all the news items, and they're graded. So the major ones and are the ones that you don't want to be trading through, because they're likely to spike when the news comes out. And if that happens and you're a trend trader, you're likely to get knocked out. If you're a news trader, that's a whole different ball game. That's up to you to play with that. But brokers don't like it because they lose too much money. Here's a list of the top 10 pairs. I call them the top 10, but it's the most we have is 14. Like I said, this week it's going to be smaller because the ranges have not been that great. And down there where Eusebio is moving his mouse are the suggested pairs per day. So based on the news that's coming out each day, we look at the top 10s and then we select the pairs based on the news. And we teach you, when you're doing the course, how to do this for yourself, because the Max isn't going to be around forever. So as Eusebio showed us with his little surgery, and Craig with his last year, things wear out. We're not going to live forever. So the Max will disappear, and at least you'll know how to select the pairs for yourself. So just underneath that was a list of instructions on how to use all of these, what all the bits and pieces mean. So with the Max ETF standard, with all the profit acceleration and the money management, account protection stuff, the course starts on July the 13th. So I think that's next week, and runs for 7 weeks. So it's pretty intense. The Eusebio is running it at 3 p.m. New York time. And so if you want to attend live, if you're doing it by video, then you get the video within about 24 hours of that. Our pre-course special is, well, the price is normally $2,999, about $3,000. We're having a webinar special of $2,399. And as Craig has written, if you want to have some sort of payment plan going, just contact him and he'll sort something out with you. I also mentioned that he put together deals with the 3 courses, the primer, the light, and the standard. And so if you want to do all 3 of them, and this is 4 months worth of training, it's $2,679. So the enrollment link is down underneath there, and Craig will be putting the link up in the chat area as well. So here's the primer. As I said, it's only a couple of sessions. It's about 6 hours. The normal price is $330. We've got a webinar special on this one at $159. This is just to give you a taste of what the Max is like. Like I said, it is profitable. Okay, and Craig has also put together a Primer Lite package. So that's a couple of months worth of work of 5 sessions. So for $759, normally around about $900, 900 to 1,000. So there's a second link there, and Craig will be putting that in the chat area of GoTo as well, and sending them out by email. And if you want to contact us, okay, down the bottom there is got our webpage, our email, and Skype if you want to chat by that and ask any quick questions. So if anybody has any questions about the Max or our trading method, then Eusebio will be pleased to answer them. I hope you're still there, Eusebio. Let me see. Stefan said he didn't say it so much, but he was a bit querulous about being able to double your money in 36 days. Or about somebody being able to double their money in 36 days. Can you comment more on that? So that's about 2 months, yeah.
Yeah, indeed. When you compound your result, and if you are profitable, the growth of an account is very important. And if you apply, for example, you all know the rule of 72. In order to have an idea of how many days or how many periods you need to double an amount of money, depending on the percentage you have as a return, you simply divide 72 by that percentage return. And so, for example, 72 divided by 2%, 1 hour with a risk of 2% is 2% per day, okay? And so 72 divided by 2% is 36. And if you make the math, you will find the same result. Now, I don't say it is easy, but you just need to accumulate 1 hour result with a 2% risk and trade every day. This is where it is not easy. You need to trade every day to double your account. Of course, this supposes that you apply the rules correctly. If you make some mistakes, you will have more losses and you will need more time to achieve your result. But the compounding process is really a very powerful process to increase an account. Einstein has qualified it as the 8th wonder in the world.
Okay. Stefan also hammered us with another question. How do you know that you're in a choppy mode?
Indeed. For each price mode we have criteria to enable us to define to help us how to define a price mode. And Stefan, if you have taken the Max Primer, you should know. And so each price mode, let me come back to the chart here.
Let's give them some extra homework.
Yeah, for each price mode, we define a set of criteria telling us exactly what the price mode is. And the choppy mode has its own criteria in terms of price behavior, in terms of moving averages behavior, in terms of range, size of the range, and so on. Now, what is true is it takes some time to define when the price is in a choppy mode. In this example here, we can say, let me take the pen here, my pen, and I will change the color to have a color which can be seen on the chart here. Let's suppose we are following this pair. It was the pound. The pair is not important. Bar after bar. At some point here, we can say, okay, now we are sure that we are in a choppy mode. And for the rest of the movement, we will have to handle the rest of the movement as a choppy mode. Because very often a choppy mode lasts many bars. Here we need approximately 50 bars, a minimum of 50 bars or more to recognize a choppy mode. But typically the choppy mode will last 100 200 bars. And so in that area, we will have very few valid entry setups. Okay. Now for the price mode, like the trend mode, the counter trend mode, and the consolidation zone mode, just 1 or 2 bars will be enough to recognize them. And so they are very, very quick to recognize. Okay.
Okay. Thank you. Stefan, sorry, Stefan, about picking on you like this. He said he's squirming in the seat. He said, and he's already done the primer course. He said that he's found it difficult to do this in real time. And I'd just like to say that trading is difficult. It's not like you see it with all the ads that come through about how easy it is and how fast you'll be able to make money. This is a business, it's a job, and it will take time to get used to how the market works and also how your platform works and all the other sort of stuff that goes on, getting yourself sorted out. If you want to be want to make money from trading, you have to be committed to it. You said
and very often one of the details, one of the important details traders are forgetting at the beginning when they trade live with the MAX is the price mode. They forget to analyze the price modes. And if they forget to analyze the price mode, they miss a lot of things of the MAX and then a lot of things in the type of movement they are facing.
The other thing that you can do is, if you can't figure out what it is, then presume that you're in a choppy mode and go to something that's a lot more, that's easier to spot. So just start off simple to start with. And then as you get better and better and more used to how the price is moving, you'll be able to pick out more trades. So it's like a baby learning to walk. It crawls first before it starts sprinting around the place. So just be gentle with yourself. Okay. Other questions? Does this work with gold and indexes?
Yes, indeed. It works with gold and indices. And in the max price levels I produce every weekend, I include the price levels for gold, for the S&P 500, the Dow Jones Industrial Average, the Nasdaq, the DAX, in terms of indices and gold, and also the Bitcoin, because the Bitcoin has been required by several of our members, several of our subscribers, and so I include these 6 instruments in our max price levels, in addition to around 15 to 20 pairs for the paying subscription.
Okay, and just so that people know, the levels are kind of like support and resistance zones, so that you know possibly where price is going to go and where it's likely to stall or go from ahead of time, so that you get some good gradings on the charts. Eusebio, as he said, produces these each week. If you want, you can get a video on how to do it. Number one, you can and it's about $50. You can get sign up for the free subscription, where Eusebio will provide you with about 2, maybe 4, depending on how he's feeling that day, charts with the levels on it, so that you compare with what you're doing with what he's done to make sure that you're doing it correctly. And then if you want the deluxe package, you can purchase the subscription model, which has got something like 20 to 25 different pairs with different instruments in it that Eusebio produces each week. They're quite valuable for knowing, like I said, where price is likely to stall and stutter or move away from once you start trading. And they're good for from the 5-minute charts up to something like the H4 daily charts, because he produces levels for the dailies, the weeklies, and the monthlies, as well as the 5s. Okay, question. Do you teach how to identify these price levels in case something happens to Eusebio? Yes, like I said, there's a little video that you can purchase as well. So we call it a mini course. Thanks,
Chris.
Stefan. Craig.
Pardon me, Chris.
Yep.
I will just mention for those who have been following the dollar Swiss trade that I had on Friday. It was taken directly off of a max price level. They're very effective. Everyone ought to at least sign up for the free edition of that, and I'll be sending out the link.
Okay, thanks. While we're on it, on the free side of things, we've also got the news watch list. You can just watch our web page, but when I update the web page each week, then I send out an email just to say, hey, check the web page because it's been updated. So there's no charge for that either. If I'd had the news watch and the top 14 pairs when I first started trading, I would not have lost so much money because I was just trading along completely unaware of what news was doing. Just thought it was for news traders, and every time I'd get hit by some strange spike, blaming the brokers like some people do, when it was a news event that I could have just stepped away from. Okay. So
yeah, the aim of the news watch list, if I can give an additional information, so here is the following. There are mainly three types of factors driving the Forex market. All the decision day by day, day after day, the decision of the central banks. Then we have all the geopolitical conditions, and then we have the news releases. And so it's difficult to make geopolitical analysis because it's endless and it's complex. The central bank decision needs to monitor them every day, and so the easiest way to try to find where the action may be is through the news releases. And so because we know in advance the news release of the coming week, so we can see where potential action may be. For example, next week, this is not our page is not updated yet, but next week we will have the non-farm payroll. But let me take another example here. Let's take, for example, here an important news release, which was last Wednesday, the official cash rate for the New Zealand dollar. And so, should the Reserve Bank of New Zealand change the official cash rate by decreasing or by increasing it, while the expectation was no change? So should they change the cash rate, then you would have seen a big movements into the Kiwi pairs and some other pairs not containing the Kiwi. And so we can say in advance that if we have an important surprise, a big surprise in these major news releases, we will have movement in the market. And so we need to follow these news when we are trading live, of course. But because we know the news in advance, we can then infer what are the most interesting pairs to monitor each day. These pairs are driven, if there are movement in these pairs day after day, these movement will be driven by the news release. And so this is why we produce them every weekend in order to help our members to narrow down the number of pairs to monitor and to get good movements to trade. Even in the absence of a negative surprise, we may still have nice movement on these pairs. Now, we will not get extremely important movement on all these pairs, of course, but very often you will get interesting movement to trade.
Yep. And lots of Max members have said that that's been really helpful for their trading. A lot of the times people are sitting there wondering which pairs they should be trading, or they're just watching the euro-dollar, pound-yen, euro-yen kind of thing, the basics. With Eusebio's top 10 and then the suggested pairs, it narrows the list down so that you actually don't need to run around monitoring so much. You're a lot fresher when you're trading, and yeah, you can just concentrate on the ones that are actually going to more likely to pull in the money. There's no guarantees, but there's a bit of likelihood. Okay, there's a couple more questions, Eusebio, and yep. I think that's about it. Which time frames to use, and how do I know when to enter a trade?
You can use any time frame. You have to choose the time frame which best fits your time constraints. If you can dedicate full time to trading, you can trade the 5-minute time frame or the 15-minute time frame. If you have other obligations, for example, if you have another professional activity, then you must consider a higher time frame. For example, the 4-hour time frame, the daily time frame, or all the in-between time frame you can build with MetaTrader. For example, the 6, the 8, or the 12 hours time frame. They are all good. It's a bad question asking what is the best time frame to trade. There are no best time frames to trade. All the time frames are good to trade. Of course, the impact of the time frame in your trading activity exists. With smaller time frames, you will have more opportunities to trade. Of course, the frequency of the trades will be higher with smaller time frames, but you will still have nice trades in higher time frames, and they must fit your time constraints. For example, if you have a professional activity and you are not your own boss, I suspect that your boss will not appreciate if you are trading the market live while you are on your job. He will not appreciate that. So you have to combine your trading activity with all your other activities. The trading activity must fit harmoniously in all your activities. And when I say activities, it's not necessarily a professional activity. You may have also family obligations, for example. So you must find the best time frame which fits your constraints. And there are no best pairs to trade. So this does not exist. All the pairs are good to trade if we have events driving that pair.
Now, Eusebio has such long sentences. Okay, and the corollary to this is another question which has come in. I think the single biggest question which comes to mind is how to determine when a trade is totally run its course and is about to reverse. So how do you spot when a trend is changing?
We can never know for sure when the trend is reversing into the opposite direction. Let's take a chart here just as an example. I will take this one here, or this one. Okay. So here we had a downtrend followed by an uptrend. Okay. The long-term bias here tell us which direction we must trade. And so when the long-term bias is red, we trade short. When the long-term bias is green, we trade long. This is the general concept. However, and so when we have a trend or a movement, a directional movement reversal, we will look for one of the setups appearing at the beginning of such movement. Later, while the trend is unfolding, we will have other setups as trend resumption or trend continuation. And here, when we have the reversal, we have to close the short trade and consider the possibility to take the long trade. Now, we will ignore, in general, one direction depending on a bias defined by, for example, the news watch list. If the news watch list before a news release tell us that for the pound US dollar, for example, for the pound, the bias is short, we have to short the pound because the bias is bearish for the pound, then we will have to look only the down movement, and so we will trade only short. We will ignore the long movement. Now here you can see in this example that here we had a news release on the euro, and I don't remember what was the bias. So the bias before the news release may be any kind of bias, but the news release can change the bias. And if a news release changes the bias, we will trade according to the new bias. And so in this case, if the bias is to go short, and if there is no reason to trade in the opposite direction, we will ignore the long setup. If there are no reason to ignore the long setup, we can trade also the long setup, especially depending on the types of movement we are seeing. For example, we define the concept of a true trend. A true trend, this is an example of a true trend. I will not give the complete definition of what a true trend is. And we have what we call a red magic box, which happens in this area, okay, and which is a time period when a true trend exhausts in 75% of the case. And so this means that in 25% of the case, a true trend exhausts before or after that time period. We can say in advance if it will exhaust before. It depends on the dynamic of the movement. And when we are sure that the trend, the true trend, because not all the movements are true trend, but when the true trend is reversing, then we can consider if the news do not negate that condition, we can consider also trading in the opposite direction. And we can see in this example in particular that we have also a price level, a max price level, where the price has reversed when achieving that level. So yes, with the max, we can say in which direction to trade and when not to trade. Yes, Chris, next question.
Okay. Oh, right, thank you. Excuse me. There are no other questions, Eusebio, so
okay.
We can wrap it up here. If anybody does have any questions, then just please email us or Skype us. We're happy to help on that side of things. There's no problems with that. And yeah, thank you very much for coming along here. Congrats to Mike for winning the course. See you in a couple of weeks in the Primer course. And hello to everybody else who will be attending our Primer and Standard courses. I know you're going to get huge benefits from them. So thank you very much.
Thank you very much for your presence and to have invested your times, almost 2 hours in our presentation. So we are really grateful for that.
Oh, sorry, 2 more things. Remember, at the non-farm payroll, Eusebio will be giving an example of what the trading is like. And we'll leave this up here on the screen for a few minutes if you want to take down any of the links, but they'll be coming through in emails anyway. So thank you, and we'll wrap it up here. Bye for now.